Hello, everybody. Welcome into Commodity Culture, where we break down commodities markets, sound money principles, and geopolitics, all with the goal of making you a better investor in the commodities sector. My name is Jesse Day. Today is February 10th, 2026, and I'm thrilled to welcome David Jensen to the program, the author of Jensen's Economic, Precious Metals, and Markets newsletter on Substack. David provides an incredible breakdown of the silver market today, including why glaring and growing supply deficits of the metal will send it to multiples of the current price, along with discussing why he thinks an alternate economy using gold and silver isn't some distant pipe dream, but a reality that is starting to form today, as trust in the political and banker class plunges to an all-time low. David also highlights the infamous day of January 30th where silver plunged 26%, why the CME COMEX circuit breakers should have triggered but didn't, and so much more. So strap yourselves in for my conversation with David Jensen. David Jensen, it is great to have you on Commodity Culture. What a roller coaster it's been for precious metals markets over the past couple of months. A lot to talk about today, but I want to start with silver. Its incredible run to triple digits and subsequent sharp correction. We're now sitting around $80 an ounce. Very impressive. Despite the pullback, what do you think caused both the parabolic rise and subsequent decline in the silver price?
Well, the entirety of the run was based upon physical shortage. We've seen just a tremendous demand in terms of silver delivery from the major vaults in London, New York, and in Shanghai as well. So the run was definitely driven by demand, and we started to see retail buying entering the market, which we hadn't really seen for a long time in terms of activity of people buying these safe haven monetary assets from shops. And many of the suppliers were tapped out, and that drove the price very high. And then what we've seen is a shorting into the markets in New York on January 30th, on Friday, after all the other international markets had closed. And New York is a futures market, and they just drove horrendous volume in there and sold the price down, of the order of 25% in a single day, and 18% in under an hour, which should not have been possible, given that they were supposed to have these dynamic circuit breakers in place to stop trading in New York.
I want to get to the circuit breakers in a moment, but first I want to pull on the thread regarding the supply deficit. I believe we're now in our sixth year of a supply deficit of silver, according to the Silver Institute. How severe is this deficit? And obviously, there is no way to bring the needed production online, considering how much silver comes as a byproduct of other metals. It's not like when the demand ramps up or the supply side is lacking that you can suddenly turn on silver production. So do you expect prices to go back up into the triple digits driven by this glaring supply deficit in silver?
The short answer is yes. UBS predicts a 300 million ounce deficit this year in about a 1.25 billion ounce annual market. But when you look at the Silver Institute and you include, if you include the investment demands from exchange traded funds, ETFs, it's 7 years running of supply deficit. And where it's starting to show up now, Jesse, and is underpinning this price run, is in the drawdown of the vaults in New York and Shanghai, especially. They have the most transparency. I kind of discount the numbers coming out of London because of they're quite opaque, and they come out monthly, and they don't they give very little information in terms of the allocation of the silver between different parties. But what we can see is that the New York vaults are down to about 102 million ounces today, and the Shanghai vaults are at about 25 million ounces today. But the drawdown rate is just huge. I mean, New York in January of this year, or in the last, let's say, the last 30 days, has been drawn down 25%. And the Shanghai Futures Exchange just yesterday alone was drawn down 8% in a single day. So the cadence of the drawdown of the vault, and everybody can see that this is heading to a point where we need a reset to a much higher price to bring sufficient silver into the market to provide the liquidity that is required. But it's going to need a price that's multiples of the current price. It's not, you know, $85 or $90 is not going to do the trick. So yeah, so underpinning of demand of the price through the really intense physical demand from these available exchanges.
Let's talk about the circuit breakers, because one of the main controversies arising from the rapid decline in the silver price is the fact that, as you mentioned, CME COMEX has dynamic circuit breakers that are supposed to be triggered when the price of silver rises or falls beyond a certain percentage in a given time frame. That was not triggered on Friday, January 30th, when the price experienced a total drop at end of day of 26%. Walk us through how those circuit breakers are supposed to work and your thoughts as to why they were not triggered on that day.
Yeah, so the dynamic circuit breakers are price bands, and they're basically set at plus and minus 10% for silver of a reference price, which is calculated in the hour prior to the start of trading. And what we saw there in New York was the fact that we saw this tremendous move down in the price of silver. I think it was like 18% or 17% in about 50 minutes. And you know, when these dynamic circuit breakers kick in, typically there's a visible pause in trading. You can see the line stabilizes, the price line stabilizes, and there's an announcement from the Chicago Mercantile Exchange, from the COMEX. And so I was watching the trading, and I didn't see these circuit breakers kicking in. I could find no mention of it. And by the way, the reason for these circuit breakers is it just allows the market to calm down. When you have these heavy selling events, it allows things to settle down, for the bids to fill in, so that there's not a panic sell-off. Many of the traders, they have stop losses, which are price points. Once they're violated, it causes automatic selling, and to limit losses when the prices have excursions beyond whatever the investor's risk tolerance is. And what you don't want is a selling off, heavy selling off, and then triggering of all these stop losses to cause a cascading of the price. And that is exactly what we did see, was a cascading of the price in New York with no pause in trading. It's normally a 2-minute hold that lets the market settle down. So anyways, I sent an email to the Chicago Mercantile Exchange, and I said, well, you know, did not see any circuit breakers kicking in. And they said, well, we had these velocity logics, is what they call them, VLs. And there's two different types of them. There's a velocity logic narrow and a velocity logic wide. And a narrow velocity logic is a price movement of 20 cents up or down in a single millisecond or less, one price tick. And a velocity logic wide is a movement up or down of 60 cents in a 1 second look back window. And so they said, well, we had violations of these velocity logics. And then what that does is it puts in a 5 second hold, which is not announced. And then it resets the dynamic circuit breakers, which are the plus and minus 10%. They get reset based on the current price when this velocity logic 5 second hold is put in place. So in essence, what you have is these protective devices to prevent massive sell-offs in the market, but they can be continually reset, especially with these high-frequency traders who can set the price anywhere they want. But you know, you can easily trade and move the price 20 cents in a 1 millisecond or a one-tick trade, and then reset all of these guardrails, which are meant to prevent sell-offs. And so when you look at it overall, Jesse, it's that these protective devices that are there, the guardrails to protect investors, can easily be continually reset and violated with trading by these high-frequency traders. And the circuit breakers appear to be circuit breakers in name only. It appears that they can basically be turned off at will by the big hedge funds and the CTAs that play in the market.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. Well, there's been a lot of speculation in this space about the rampant price suppression that has gone on for decades in both gold and silver markets, largely perpetrated by bullion banks. Where do we stand today on the question of precious metals manipulation, considering how far and how fast both silver and gold have been rising? Are we nearing the end of the price suppression era, so to speak? Was the price smash on January 30th a last desperate attempt to scare people out of the metals, or do you think this is a game that's going to continue on for longer?
Well, I think the attempt is going to be made to price fix. They've been using a price fixing system, which is trading of promissory notes, primarily in London, which is the big physical market. It's the dominant physical market. And that works fine as long as people are ignoring the market in general, and there's not a very high physical demand. You can provide infinite paper supply, infinite promises to deliver metal as long as nobody asks for the metal. And so what we're seeing here is with the tremendous drawdown in Shanghai and New York and London vaults of the silver stock, the market is becoming physical because of true shortage. And shortage is what you expect when you go through a period of price fixing to the downside, in that it cuts off supply, it stops mining development and movement of metals to the market to satisfy market needs. So as it goes on for a period of time, you draw down the available stocks. And then when you reach the crisis point, which is where we are now in the silver market, is that you just don't have the productive capacity to ramp up the production to meet the true need for the metal in the market. And on top of that, we also have the whole issue with that we're ending an era here of debt based speculation in the markets based upon very very loose monetary policy by the central planners at the central banks. And so just as we have the drawing down of available inventories, we also have a tremendous need for these safe haven assets. And the two of these market features are coming head to head here, and that's what's causing this tremendous dynamic activity in the silver market.
You released a fascinating article on your Substack last week titled "Shock Silver Price Premium in Shanghai Will Quickly Drain Western Market Vaults." And you noted that after the silver price smash on the CME COMEX, the Shanghai silver price traded at a 29% premium to Western markets. How is that price gap looking today, and how can it result in Western vaults getting drained?
Yeah, so the premium in terms of a spot market is about $6 an ounce today. So that's about a 7% premium. But when you actually look at the true price of silver in China, if you're an industrial user, um, there's a 13% VAT tax on top of that. So when you look at the metal brokerages and the big industrial data collectors in terms of metal prices in China, today the price of silver, if you want to buy it for in bulk on a wholesale basis, is running about $99 an ounce. So that's a very material spread versus the Western price of around today. It's about $80, $81 in the cash market, in the spot market. And the cost of moving silver into China from the West, either from Europe or from North America, is of the order of about $2 an ounce to pay for transportation and insurance and logistics, etc. So there's a very large incentive there to move metal into the Chinese market, whether it's smuggled or it's done out in the open. You got a $15 plus spread A million ounces of silver in terms of volume, is a very, very small amount, and can be easily and quickly moved from Western vaults. And I think that's why we're seeing this drawdown in the vault stock. There's roughly 100 million ounces in New York in the exchange vaults. And as I said, it's been drawn down by 25% over the last month. And the drawdown appears to be in a highly accelerated mode, which is continuing. So yeah, there's tremendous demand in the market for physical silver, but it's spread to Europe as well as North America and Asia, India, China, etc. There in the Asian side of things. So yeah, there's a confluence of events here, and there's so much momentum. I just don't see it stopping anytime soon.
And how do you see China's role in the silver market being played out moving forward? Because there's been a lot of talk about them buying up silver concentrate directly from miners, smelters, I believe, in South America, as well as the fact that they're one of the largest silver producers in the world. They have put some sort of export controls. Maybe if you have some info on that, you could give us on silver leaving the country. At this point in time, do you think the Chinese government realizes everything you're saying right now that we've discussed so far, the importance of silver, and how do you see them playing a role in the market?
Yeah, it's interesting. Like in the last week or so, the Chinese authorities have gone after traders in the Shanghai Futures Exchange for what they say is violation of trading rules in terms of volume by various players, etc. Um, it's hard to say. I never take things at face value at this point. So are they really? Are they really? Lassoing individual traders who are pulling metal out of the market. They're now down to 25 million ounces available in their exchange vaults. Or are they truly going after traders who are trading against the exchange rules? Very, very well, impossible to say from the outside. But they are fining and suspending traders en masse now in Shanghai. But that does not trade. That does not change the tremendous drawdown. When you see yesterday an 8% drawdown in the total vault stock in Shanghai, something's going on, and there's discussions about major short players, and there's a lot of speculation about what's going on. But the one thing we can see is this cadence of drawdown of the vault stock of silver is accelerating, and we're getting down to very, very low levels. Even when we look at overall in the Shanghai vault stock now, it's down to 10% of what it was in 2020. There's been a 90% drawdown. There was 250 million ounces. Now there's 25 million ounces left. Yesterday, they pulled down 8% of the available stock. So, we can see that this is days and weeks to resolve itself. And I think we're going to see an explosion of price activity and volatility as this comes to a head. Is that the metal is essential. There's an increasing demand for it, both as from the industrial side, as industrial users forward buy to ensure supply. It further stresses the market. But then there's also this entrance of the Chinese retail buyers who are understanding it as a safe haven monetary asset that is nobody else's liability, and that's very attractive given the financial and economic problems that we see rising in China right now.
And when it comes to the length and trajectory of this bull market in precious metals, how do you see it all unfolding? I've spoken to different people with different opinions. Obviously, some people think we're closer to the end of this bull run, perhaps a few years left. Gary Savage would be in that camp, and others who believe that it's going to be a much longer, sustained affair. I have Ed Steer on the show recently, and he's mentioned that he thinks silver will eventually get to prices that we can't even imagine given the setup. He speaks about a lot of the same things you have. How do you see this silver bull market unfolding up ahead?
Well, we're in a we're at the end of many decades now of monetary expansion and bubble blowing by central banks, and it was based upon a credit bubble and loose money policy. Our currencies are all underpinned by debt. They are debt-based fiat currencies, and so we're heading into a currency crisis because the debt is now at unsustainable levels. And so, if you believe that we're at the peak, you must believe then, in terms of metal prices, then you must believe that currencies are going to be strengthening. And I see no evidence of that. I see that we've had the world's capital markets. If you look at securitized bonds and equities, total global financial market value of tradable assets is about $270 trillion. And when you look at the supply of gold and silver to market in terms of current projected supply in 2026, it's about $0.9 trillion. And so we have this, the equity bubble is underpinned by low interest rates, as our bonds, and we're seeing accelerating default at the margins in the less creditworthy elements of the credit market. And the equity markets as well are underpinned by loose monetary policy. So that the markets set interest rates, and they are forcing interest rates higher globally right now. And so as these bonds decline and as the stock market will ultimately respond to higher interest rates, there is going to be an accelerated demand for these safe haven assets. And ultimately, it ends, Jesse, in a currency crisis. And that is not a recipe for a peak of gold and silver prices.
Well, I want to discuss the gold market specifically here, as we did see gold correct along with silver, platinum as well. Though gold correcting far less dramatically, it has also recovered from the correction faster. We're already back to around $5,000 an ounce, a little bit over, I believe, is at the time of this recording. Is gold showing itself to be the superior monetary asset here, perhaps the more stable monetary asset? And how much farther do you think we can go in this bull cycle for gold?
Well, gold is going to be the official monetary asset. I have a view that we're going to see private money circulate because of the tremendous failure of what I call garbage government currencies. These fiat based currencies that are created by the governments, the banks, and our central banks are extraordinarily unstable and they're unsound. And I think that, what we're starting to see now, and I'm hearing about, and I've actually seen myself, is an initiation of exchange using physical silver. I was not a party to the exchange, I just happened to observe it, but people actually using silver as private money as a substitute for the currency. And I think that's going to accelerate. There's an estimated 5 to 8 billion ounces of silver in the hands of the U.S. public overall, and that's not all in coin and bar form. Some of it's in industrial applications and electronics. But as the price of silver goes higher, people are going to do things like finding old silverware sets in the attic and starting to capitalize on the accretion of wealth of these assets as the price goes up. So I really see now a movement into private money as a parallel to these unstable and unsound currencies that our governments have developed and promoted and ultimately completely distorted our society with. So I would see much higher prices in terms of fiat pricing, but also in terms of the value of these assets versus things like buying a house. Like I do think we're going to get to the point where you can buy a house with 5 ounces of gold. I think it's likely inevitable. So yeah, I don't know if that directly answers the question, but that's my sense there.
Yeah, great answer. And I want to get your take on the concept of selling metals. I mentioned two names earlier, Gary Savage and Ed Steer, and they are both on opposite ends of the spectrum when it comes to this. Gary Savage believes there will come a time to sell all physical metals, to invest that capital into something that presents a more attractive value proposition. Ed Steer said that although he will be selling his mining shares, he will not sell a single ounce of physical at any price because it is real money, and why would he trade it for fiat currency? So these are obviously kind of more an investor trader mentality versus kind of a sound money advocate mentality. I wonder what your thoughts are. Is there a point? Is there a price at which you would sell some or all of your physical metals, or do you believe in always holding on to them for insurance policy, so to speak?
Yeah, well, we have two different beasts, right? We have money, and if you look at Aristotle's definition of money, it had four characteristics, and one of them was intrinsic value. And so, gold and silver are the only assets that meet that definition. And then we have on the other side of the ledger, we have these fiat currencies which are dying. And so, in terms of selling precious metals, like I'm starting to see now, as I mentioned, that we're starting to see a parallel monetary system starting up very slowly, but it looks to me like it's inevitable that it's going to function at an increasing pace in the years ahead. And so my view is that you don't sell money, you use money. And so, why would I want to exchange sound, secure gold and silver for fiat currency unless I had a short-term transaction that needed to be done in the monetary system? So, what I'm seeing coming, Jesse, is a use of gold and silver for transactions, which is going to be not welcomed at all by the governments. Most of our government officials are leaning in the World Economic Forum total control direction. They're either members or have sympathies with them. And my view is that their days are nearly over, and that humanity is finding a footing. We've been asleep for a long time, a very long time, and people seem to be waking up. And with that waking up is the reawakening of gold and silver as monetary assets.
Very interesting. And I'll get on my soapbox here for a moment and say something that I often say, which is these people who are in charge of the monetary system right now are actually deeply evil people. They are not incompetent. This is my opinion. They are not, just doing it to benefit themselves. They're doing it to purposely inflict harm on others. Maybe I could get your thoughts there. Do you have a similar mindset? Because I often run into the argument of kind of incompetence versus malice, whether a lot of the people here or just simply for their own personal gain. But I believe there's kind of an interconnected network of elites. I mean, in some ways, perhaps the Epstein files have shed some light on this. But do you see the people in charge right now as, just trying to get by within the system they're in? Do you see them as evil individuals trying to kind of inflict their agenda upon the world? How do you view that?
Well, the currency system that we use right now, when you look at it from the outset, it's just a question of math that the system is unstable. And when the London Bullion Market Association was created by the Bank of England in 1987, the Bank of England, who are the currency printers, were given authority over the world's biggest gold and silver market by the Thatcher government with their Big Bang financial reform legislation. So they gave the currency printers control of gold and silver. Gold and silver are the alarm system of loose or unsound monetary policy by the central bankers. So the central bankers, they created this promissory note trading system in London in 1987 that traded promises as opposed to metal itself. And as soon as that was instituted, it was known that it would lead to collapse because it's a price fixing system. And when you have price fixing, in the end, you always have collapse of the scheme when you run into a shortage situation as we're in now. So what we've had in the intervening years is a series of credit bubbles that blew the biggest financial asset bubble in history. And the revolving door between the financial industry and the central bankers side of things has ensured that this whole scheme would be pushed to an absurd extreme. And that's where we're at now. So, in the meantime, there's been trillions of dollars extracted from society by the financial industry, which has benefited from these series of bubbles. So, it's what was it? Roosevelt, FDR said, if something happens in politics, you can bet it was planned that way. He said that nothing ever happens by accident, right? And so I think if you look at the monetary system, which is at the core of our society. We've got a fiat currency system, which was very carefully crafted and designed to allow continual expansion, government deficits, war fighting, and then also bubble blowing, which has been operated par excellence by our central bankers now for decades. And the whole thing, Jesse, is coming to a sorry end. It's quite pathetic, actually, watching it unwind here. And it would meet with only scorn, except for the terrible consequences of currency disruption and the impact on our society as a whole.
Well, you spoke about a parallel monetary system potentially emerging involving gold and silver. Um, Maybe you could talk to us a little bit about the signs that you see that lead you to believe that is happening. And secondly, how could that ever be adopted on a large scale? Because we often run into the argument of, well, are people going to be walking around with silver and gold coins in their pocket and buying groceries? Because at this point, especially if silver continues to rise as much as a lot of people on this show believe it will, silver will no longer be kind of a cheap metal you can just carry around for everyday barter. If we get high into the triple digits, um, there's been talk, of course, about silver and gold on a blockchain. Perhaps that's one method. We've seen some interesting concepts such as gold backs out there. I wonder how you see a parallel monetary system emerging, perhaps on a larger scale, and just the signs you've seen so far that lead you to believe that could take place.
Well, yeah, Alan Greenspan himself said that his term was ad extremis. So, in the extreme, fiat currency is always rejected, it always collapses, and gold is always accepted. So, that's not me saying that. So, and when people talk about using gold and silver for barter, it's not barter because gold and silver are money. And so what it is really doing is it's moving from using unstable, unsound fiat currency to using sound money, which, gold and silver have a 4,000-year history as being money in our society. It's respected in all cultures, in all geographic locations on the planet. And you go online and you look in Facebook and other places, and auto mechanics are offering services for dollars or for silver. It's not hard to find, and I've seen it in farmers markets and in other settings, and it just seems to me to be basically an organic transition from using unstable and unfriendly currency to using stable and sound money, which preserves its wealth and actually, because of the phase that we're in right now, it actually increases in value quite rapidly over time in comparison to labor and other assets. So, and I think it's only going to expand in the future. And some benchmarks we can look at when there's been currency instability, like Argentina, they had a peso crisis in 2002. A 60%, 65% overnight debasement of the currency or devaluation of the currency. And basically stores shut down. They would not accept the peso anymore. And because people need to eat, farmers markets started up in the streets. And because it was organic and there was nothing official about it, they had to have a monetary unit. And what became one of the primary units of exchange, they couldn't access US dollars. Only the wealthy could access the US dollars through the banks. That people were using individual links of gold necklaces as a basic unit of exchange. And we've heard about Venezuela, 10 years ago, Bolivar crisis. You could buy a month's supply of food for a person for a single ounce of silver. So, the respect for silver and gold as monetary safe haven assets appears to me to be embedded in our DNA. And we forget about it. But then when we enter periods of crisis, as we are entering now, the use of gold and silver as money, not as barter, but as money. I'm going to give you something as a medium of exchange, which holds its value and actually accretes value. I think that becomes increasingly respected, and no government edict can stop that. And the fact is that the metal is in the hands of the public already. That's distributed throughout society. People just need to hit the attic and find this stuff, and you will see it move. And I think that they will do these things as the as the failure of our fiat currency becomes more and more clear to the average person.
Well, let's talk about what that failure ultimately looks like, because the debt and deficit situation in both the US and around the world has become almost ridiculous at this point. Governments have no way to pay back the debt or any interest in doing so, and their solution continues to be print or die. People have been talking for decades about the monetary and financial system being on the verge of collapse. We haven't seen it yet. How much longer can they kick the can down the road here? And what would the implications be of a systemic breakdown for precious metals, the global economy, and society at large?
Tremendous disruption. The bond market sets interest rates, not the central bankers. Central bankers set the overnight rate, but rates overall are set in the bond market, and we see the 10-year and the 30-year bonds of U.S., of Canada, of Japan now appears to be in a tremendous period of crisis. It is signaling an unwillingness, increasing unwillingness to hold these fiat denominated assets for, if you have a 10-year current, a 10-year bond, pardon me, and it's denominated in yen, whatever interest that you think you're going to be getting from that paid by the Japanese government is clearly going to be overwhelmed by the decrease in buying power of that currency, right? So we return to a period in the 70s, they used to call bonds as certificates of confiscation. And that's what people are seeing now, is that the currencies are unstable. The debt denominated in the currency is thus unstable as well. And so, because of this leverage, of the $270 trillion of bonds and stocks versus less than $1 trillion of supply of gold and silver annually to the market, it speaks of a rapidly increasing price of gold and silver out there as a new sound monetary system is defined by humanity. Ultimately, what I think we're going to be seeing is rapid decline in the buying power of currency as assets are allocated into real assets. Financial assets are reallocated into real assets, including food commodities and other raw materials such as copper. So because of the financial system leverage that's been built up, this can happen very, very quickly, right? The currency that's been printed has been sequestered into financial instruments for a period, but now a very small part of it has to go into commodities to create what I call a rapid onset inflation or rapid onset hyperinflation. Hyperinflation being defined as 50% increase in prices in a year. So I think that can happen very quickly because apparent wealth, has been parked in paper, and the paper is burning now. People can see it, they can smell it, and they're starting to become kinetic in terms of moving with their feet into real assets like gold and silver.
Well, tell us about Jensen's Economic Precious Metals and Markets newsletter.
I've been looking at this market for 20 years, and it's for longer than I really should have probably. But when you understand how it underpins absolutely everything around us, in terms of currency stability, monetary stability, and our society as a whole, once you look at it, you can't look away from it. So what I've done is I try to put out a couple, 2 to 3 updates per week. The Substack is Jensen David, so Jensen David David .substack.com, and I try to distill it down into something people can read in 5 minutes. I know people don't have a whole lot of time, so I try to distill that 20 years and 30,000 hours of research into kind of cogent as best as I can into distilled notes so that people can understand big picture or see an insight that might help them make better decisions, especially in this chaotic time.
Well, I'm going to put a link in the description below to the Substack. I recommend it. I'm a subscriber, and I limit the amount of newsletters I get because there's just so many out there, and yours is one of the ones that I actually read top to bottom every time it hits the inbox. So check it out, guys. The link will be in the description below. David, thank you so much for coming on the show and sharing your knowledge with the audience.
Thank you, Jesse. It was my pleasure, and let's do it again sometime.
Thank you for joining us today. This episode is brought to you by ARC Silver, Gold, Osmium. They have some great prices on precious metals, bullion. They are on your screen right now. These are subject to change, and while supplies last, so reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him that Commodity Culture sent you and pick up your Stack Silver, not Fiat t-shirt. Represent sound money in style, backed by 100% quality guarantee. Use the link in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.